Thanks, Dawn, for taking the time out to come and join us today. So without much ado, it's Wednesday. Sorry, it's Wednesday evening, and we're coming close to CNY. So let's get to it. Over to you, Dawn.
All right. Hi, everyone. So my name is Dawn. For those of you who don't know me, I'm BudgetBabe. But if you're here today, I guess you must have seen it on my social media account. So anyway, today we're going to talk a little bit more about this interesting category of products that have come up in recent times. And it's fairly new, right? So when it comes to putting our money in places, most people generally look at whether or not you have a lockup option. Because let's face it, right? We are not exactly the biggest fan if you have to lock up our money somewhere where we can't touch it and then you give us a really, really low rate in return. So that's why in recent years, with all the different bank accounts doing high yield savings, that's been very attractive, but that is slowly being cut as we speak because of global interest rates all around the world with the money printing and the economic issues. And then after that, on the other hand, you have your fixed deposits and short-term endowment plans, which are still fairly good. They're giving you anywhere between 1% to 3% if you're a saver. But the problem is you have to commit to a lockup. So what if you actually need that money, let's say 1 year down the road? Or like, let's say, for example, if you're pregnant like me and you're planning for a big purchase, because we all know the delivery fees is quite extensive, right? So if you know that in 6 to 7 months time, you're about to deliver, or you have a wedding, or you have a big purchase coming up, you want to put your money somewhere where you can actually withdraw it easily. But within this short period, you just want to get a little bit better yield at the same time. Then these lockup options is not going to appeal to you because they usually come with at least 1 year, if not 3. And we've recently even seen 5 years, which I don't think really makes sense given the kind of rates that you're getting. So the interesting part is that recent times have seen this new development category whereby you have cash management account. And we're going to talk a little bit more because I realized that a lot of you guys have been asking me, what exactly is this? Is it safe? Like, how exactly does it work? Are they going to run away with my money? Is it like really, really safe? You know, banks are FDIC protected. What about in cash management, right? So we're going to address all of this, help you understand how they work, and address any questions you have on security issues or safety. So feel free to send in your questions and we'll get back to it. So yeah, on this part, that brings us to a higher return at the cash management account. So on the next slide, we're going to talk a little bit more also about the Singapore Saving Bonds. Because remember when it was actually launched several years ago as well, it was super popular, right? And everyone could subscribe and get like anywhere between 1 to sometimes even 3%, depending on which month and which year that you subscribe. Generally, though, it was about like 1 to 2 for majority of the time. But in recent times, just look at that number now, man. It's like in February, that is 0.97% for 10 years. Imagine keeping your money in there for 10 years and you're only going to be getting an average of 0.97 across the whole period, you know. I think like inflation, by then your $1 or more like your $3 chicken rice maybe become $5 already. So your money is not going to help. You're not hedging against inflation. It's hardly enough, right? But then on the other hand, where else can we go? So that's why you might want to consider cash management products. And on this next slide, okay, I actually had a graphic, but then we had to update this because there were some changes in the yield scene, and I think this is going to be the norm moving forward. So always keep an eye on the yield as well. So remember right now, savings accounts are like 0.05. You're not going for the special ones. If you are, they're also cutting the rate. So it's very hard to project where exactly they sit. I would say on average now it's like slightly less than 1 to 1 plus or even 2 plus if you can fulfill all the different requirements. Now, on the other hand, this new category of cash management products that have been coming up, generally being offered by your brokerages or your robo-advisors. And it's actually really interesting because it gives you rates that are way, way better than putting it in the bank, but yet it doesn't have the lockup requirements that the fixed interest and endowments actually impose on you. So with these rates being anywhere between 0.25 per annum, all the way to 1.6% per annum in the past few months. But then, just a few months ago, Syfe basically came in and disrupted the scene. So when they reached out to me to tell me about this, and I attended the what do you call it, the soft launch media launch, the closed door media launch, I was actually really excited because like 1.75%, we were like, oh, wait. How exactly are you getting those rates? Right? We want to know that we're not being smoked into anything. And what's the catch? So it is actually quite interesting because there are no deposit requirements, and they're going to explain a little bit more on how they get the yield. So over to you, Drew. We want to understand a little bit more. Why did you guys launch this? How does it work? Is it really safe? Let's go through all of that today.
Sure. And I think thanks, Don, for the intro, right? And I think that's the purpose of today's session, right? We really want, there's obviously when these things come out, there are a lot of questions which is only normal for users to ask, and ask us anything, and we'll be happy to get through. But maybe give me maybe in the next 5 or 10 minutes, I'll just walk through some of our slides, and I believe a lot of your questions actually probably will get answered. Right. So just to give you a bit of, premise as to why did we launch Cash Plus. Now, most of us know us either for our Equity 100, our, RE, or obviously the very popular REIT offering. And what we thought was that when we looked at these portfolios, we've always built portfolios with what is the kind of expectation that users have. And conventionally, it's either been something like, I want growth for the long term, or I want global exposure. That is where something like an Equity 100 comes into limelight. Or people say, I don't want any currency risk. I just want some sort of passive income, which is where something like, REITs come into play. Now, the reality was, no matter which option you took, somewhere there was some sort of a risk associated with these offerings where they could lose, some part of their value. Now, what we actually realized was for a lot of the users, either by the virtue of them being new to the idea of investing and hence losing money, or actually being very, very savvy, but just feeling that this is not the right time for whatever reason, markets have all-time highs and all, maybe this is not the best time for me to, actually invest. What can I do, which is something that's very, very safe, but still giving me some sort of a return where at least, I'm beating inflation, right? So I think that was the premise, what led us to launch, Cash Plus. As you can see on the risk bars, right? Essentially, it's one of the least risky option that we have on the platform. And the reason for that is what we really invest in, right? We basically invest in money market funds, which essentially means that we invest in government treasuries, alongside which we invest in some investment grade corporate bonds, and something, I'll talk a bit more about as we get along. So let me first quickly go through the highlights. So firstly, the projected yield is 1.75%. Now, some people say, hey, is this projected or is it actual, so on and so forth. In fact, anyone who's been on the platform since we launched, in fact, the last 1 month, if you just put it, actually the yield is even higher than that. So we did take into account, and, we want to give numbers that, we believe we can at least deliver at least on a quarterly basis, if not for longer, right? So when we know things are changing, we will update it. But as of now, in fact, for the first month, the yield that has been generated is actually even higher than 1.75. The second and really good thing about it is there's a daily accrual of returns. So the amount actually comes to your account, as soon as basically, it gets accredited, because you see the NAV itself of your, portfolio increase. So even if you are here for a shorter duration, right, you are still going to be making something out of it, just because of the virtue of, you being present. So it's not like you wait for 3 months and then there'll be the first rebate, and then wait for 3 months, there'll be a second rebate. It's happening on a daily basis. Now, the second thing is, of course, there is no minimum investment. You can start with as little. There is no maximum as well. I mean, we had a client, in fact, when we launched, who basically put, $2 million with us, right? And he's not the only one who's putting tickets of that size. The reality of that is, because if you really have that kind of funds, and if you go to a bank, generally, more often than not, they're actually discouraging you. I've been hearing these stories where they're actually telling no to FDs. And even if they're doing, the rates really actually are not attractive at all. Plus, you have to lock up the money, and, rates are already so low. There's a possibility that they might actually move on the uptrend, right? So would you want to lock yourself for a year, 3 years, or 5 years for something which is so low? So the advantage is actually, and I think this, I would say the no minimum investment advantage is probably okay, but I think what has been really unique is the no limit, right? And I think that is very interesting, because not only are we doing that, we're not putting any lockup, periods. You can withdraw as little or as much as you want, unlimited times. There is no, cheeky metrics, right? Because normally, many times, if you want to get that premium offering rate, you need to do, you need to fund the account, do 5 transaction, ask your, grandfather to open an account, and only then will you get that, promise of 1%, right? But here actually what we are giving is very straightforward. You get what you see, and, essentially there is no, hidden caveats, right? I think one very unique thing, and we've already seen a lot of users actually find a lot of value in, is the fact that you can transfer, very easily between portfolios. It's literally a one-click transfer where you can literally move funds from your Cash Plus to other portfolios. Now, this is actually a very useful feature because I think a lot of people do prefer DCA, and they prefer to, pace out their investments, let's say once a month, and so on and so forth. So what you can actually do is you can, put these, amounts in Cash Plus, and at the time when you want to move the funds over, at just, a click, you can move it to your existing portfolio. So that level of, granularity and that level of, access is great, because till the time you've actually made that transaction, you are getting, the projected yield. And I think that is something which, cannot be negated, because a lot of times, we talk about this human psychology of analysis paralysis. Till the time you're waiting for that right time, and that's a whole debate, what is the right time, at least you can optimize your resources to the best possible things. And this was very tricky to do, and especially with lockups and costs and barriers, but that is something which we have removed with the Syfe Cash Plus. Now, also interestingly, we are very soon launching a feature for recurring transfers. So currently you might have to move it yourself, but I would say probably in the next 2 to 4 weeks, you will see a functionality where you can preset a transfer date on a monthly basis, and then essentially just transfer to the portfolio of your choice. So whether it's REIT Plus, and let's say you have $100,000 in Cash Plus, and you move $5,000 every month, you can literally just set it up, and it will automatically keep on doing the transfer at your chosen, your defined intervals. So in summary, we have a projected yield of 1.75%. As I mentioned, last month, the yield actually was higher for those who've experienced it. There's a daily accrual of return, so you don't have to wait for 3 months or 6 months to see what you're getting. You can transfer funds conveniently across all the portfolios, right? And very soon, in an automated fashion with, a tool that we are launching both on the app and web. There is no minimum, but more importantly, there is no maximum as well. There is no lockup period, and they're unlimited free withdrawals. So actually, as you can see on this overview, right, essentially there is no real catch to it, right? I mean, we are a very, finance heavy and finance background company. Most of my career was in banking, but most of the core team is extensively in banking as well. So we've tried to build something which, takes away what we think have typically been the most annoying features of, conventional so-called yield generating or smart kind of saving instruments, and that's what we've built with Syfe Cash Plus. So the next question obviously comes is, where do you actually end up parking your funds? So what we do essentially is we break it up into 3 different funds. One of them obviously is a conventional SGD money market fund, right? This eventually invests in short-term, very high quality AAA, commercial bills and paper, very, very, essentially backed by MAS, Singapore government bonds and so on and so forth. So this actually is a very, very stable, but this alone does not, give you ample yield. In fact, if you only invested in this, your yield would be probably closer to, the lower side of what Don was sharing earlier, and you'd probably only get something like, 0.6, 0.7%, right? But what we do with that is we actually, which comes from the other 2, products in this, in Cash Plus, is that we end up investing in what we call investment grade corporate bonds. Now, what does investment grade corporate bonds? Investment grade corporate bonds generally mean very high quality corporate bonds. So, give you an example, one of the bigger components of this portfolio, the corporate bond aspect of the portfolio, is something like Standard Chartered, right? Which is a very well-renowned, well-respected bank, as you might have heard, right? So essentially, we've still chosen those aspects which we know are still actually very, very safe. And fundamentally, if these things start like defaulting, then the risk you run is actually even much more severe. But on average, if I look at the portfolio, and I don't think we have it here, but on average, about 60% of this portfolio is in government or government-backed assets. So super safe. biggest single asset allocation is the Singapore government itself, right? The 40% actually goes, into the corporate side. But if I look across the board, there are almost 100 plus, kind of bonds that get into across these three funds, right? So that level of diversification means that even God forbid, if one of them, did not perform, the overall impact will actually be very, very limited to your portfolio, right? And that is the power and beauty of, doing it in a diversified fashion, such as the way how we are doing it here. So, of course, what is Syfe really charging us? Well, there is no management fees. Exactly, it's a zero management fees. Above that, we are giving 100%, trailer fee rebates. So then the question is, how do you actually come to this 1.75% number? And again, we are very transparent. The gross budget return of everything that is offered is roughly about 1.8%. The entire fund level fee, what gets charged, is roughly about 35 basis points. So that comes to roughly about 1.45%. But we have an overall rebate structure which comes up close to 30 basis points. So effectively, if you add off all of that and with the free management fees, your projected return is closer to 1.75%. And I think that's great because, you essentially are seeing where things are really, breaking down, where are we getting charged, where are we actually getting your rebate and all. As you said, it's a 100% rebate structure. We pass everything that we get from our fund managers. So something I showed earlier also, right? Like, again, this is probably catered to those people who either are using as a place to temporarily pass funds before deploying them, temporarily pass funds because they want something which is very low risk, right? Whereas if you go to something like, I guess our REIT Plus or the RE, and of course, then if you go to something which is high risk equity, it's something like the high risk, high return, right? So if you basically move from left to right, the red bars actually show you about what is the kind of risk you're taking, right? And at the same time, obviously, for lower risk, you have relatively lower returns as compared to maybe an equity 100, but obviously you're taking much lower risk, but you're still getting much higher returns as compared to, let's say, something like a regular saving bank account. Okay, how are you feeling, Don? Should we get through the slides or should we take some Q&A? I see a bunch of questions coming up. What do you think?
Before we jump into this, we should definitely do some Q&A. Then after this, we're going to talk to you guys about why stopping at cash plus should not be the way, because we all want to see you make way more than just 1.75, right? And we're going to talk to you about how you can go beyond 1.75. But first, let's talk about cash plus. Yeah, I see some questions coming in as well. You want to talk about, I think there are some who are quite concerned about in what circumstances will there be negative returns. I think that's a really good one to address.
Yeah. So, I mean, it's a great question, right? So essentially, and, I'm assuming we have a mixed audience, so I'll try to, keep it simplish in explanation. How bonds actually work is bonds are issued either by governments, let's say like, Singapore government, or by corporations like Standard Chartered, as I mentioned. And they say, okay, if you invest with us for X amount of time, we will give you Y return, right? Now, the reality is, unless the entity which is issuing the bond defaults or actually shuts down, etc., right? They have to give you the return what they have really promised, right? Because if they don't, then technically they are defaulting. And again, I'm saying, like, imagine if the Singapore government defaults, right? I mean, then I think we all have much bigger problems, right? But the reality is that given we go for only high quality governments or essentially investment grade companies, this possibility is extremely low. That is actually the only possibility in which you will have a negative return, because maybe that component of your bond has not fired, or it's given out, not returned its capital, etc., as the case might be. Temporarily, when there is a liquidity squeeze, or there is situations like March, etc., which happened, at that point, temporarily, your portfolio can generate some sort of negative performance. And I will even tell you what it was in the peak of March. But it's important to understand that this is always temporary, because if you wait till the end, if you wait till the time these actually bonds mature, you will come up and in the positive. To answer your question, how was this performance last year? At the peak of COVID, which was in March, that time the entire portfolio was only down minus 0.7%, right? Only down 0.7%. But the reality is, because that was more, if you remember, there was this liquidity crisis and there was, run on the banks and everything was happening. But the reality is that situation literally lasted only for, I would say, a few weeks. In fact, last year, if I look at numbers, the product in fact returned close to 3.5%. And why it did that was not only because, well, the yield, as you can see, but as you know, as the rates kept on coming down, these products actually end up even becoming more valued and more cherished, just because of the fact that they had some bonds which were giving a higher yield. So in the worst case scenario, like the worst in COVID was only down 0.7%. But again, with bonds, unless you expect the counterparty to actually default, which in our case we don't, given the nature, you actually will never have a negative performance. You just have to hold it on, till the time. Yeah.
Exactly. So I think also if people pick their owns, that's where you can have really low quality bonds, because not everyone might pay as much attention to the credit ratings or the period duration. And usually individual investors, we're only human, so we tend to go for the highest yield, not realizing that they also come with some of the highest risk. So in case, Syfe actually has that process whereby they invest in the higher quality ones. And you can actually check out the whole portfolio. In fact, before I did the entire article, I went to read up into the individual portfolios and look at the components. And I was quite okay with what I saw. Like, there wasn't any red flags that I saw in there. So I think that negative would be very rare, if not temporary, like what you said. So I hope that answers the question. Someone else is also asking a really good question. So I think they don't really understand how projected returns work. They're asking, why do projected returns change from time to time? Is it because of higher or lower default rate? I would answer this, but I think you can answer it better since you're the expert. Go ahead.
Yeah. No, so I mean, it's actually nothing to do with the default rates, right? I mean, in fact, as I said, there has been actually, I think if I remember correctly, there have been like zero defaults per se, right? When you build a bond portfolio, essentially you have some bonds which are, let's say, short duration, which might be, let's say, expiring in 3 months. And then you have some bonds which might be long duration, let's say expiring in 3 years. Now, because people stay invested, right? Once the 3-month bond expires, i.e., it matures and, gives everything back. So there was no it paid you, its principal plus, the interest that it promised. When you renew again for the next 3 months, those rates can move up and down. Think of it like if you lock yourself in an FD, right? If you lock yourself for a 1-year FD, when you lock it after the next 1 year, the rate will be different, right? This is no different than thinking of it that way. Now, because across a blend of portfolio, at any given week, there are 1 or 2 or 3 kind of bonds maturing. When you actually renew them, right, or let's say you go and opt for another bond because it's better, those rates actually might be different to what it was when originally this particular bond was taken, right? And that is why these rates keep on changing, and that is also the reason why these things can actually move up or down, right?
Exactly. So you remember the rates are on a per annum basis as well, but not all the bonds or instruments that are invested within Syfe Cash Plus is all like 12 months. So
exactly. Yeah.
Once here, a few months, and because of all that overlap and the renewals, that's why the rates are not fixed. Yeah, so I hope that
exactly, and that also allows some sort of, just to add on, I mean, that's a great way to look at it, and also that allows some sort of a stability, because we are not tied to a massive rate cut or a massive rate increase, because different products will be maturing at different periods of time. But as a user, it's a more balanced out impact rather than a sudden impact. What happens, let's say, in the case of a fixed deposit, as you guys have seen yourself. So.
Yeah, I see another one asking, but I think this has been addressed already, whereby you asked what's the performance so far since the launch of Cash Plus. I think that's 1 to 3, right?
Yeah. I'm actually, just bear with me. I'm getting the latest numbers right now from the team, but let's keep that as unmarked. I will get that answer from the team and come to you, but it's higher than 1.75%. That is what I can tell you. Let me get the exact number for you in a short moment, right?
Okay, so I think for the rest of the questions, this is interesting. So I see one from Wen who's asking, how do you know when your bond will mature? So remember, because it's different bonds and different instruments all within like one whole basket, so each of them mature at different times. So that's actually managed on Lions Global Investors end as well. So in this case, like we're not actively managing that, right? If it is, then you wouldn't go for a product like Syfe Plus. You would just go for your own direct one. But whenever you go through a third party, so there's actually professionals managing that on a regular basis, looking at it, renewing it, and that's where different bonds stagger and mature at different points in time. So we don't really need to know, but if you're curious, like I was, or you're like one of those who's super skeptical and just want to know everything before you put your money in, you can go and check out the portfolios on Syfe website. I think they have a really good link as well that helps you understand a bit more about the different instruments that your money is being invested in. So yeah, I hope that helps.
No, thank you so much. Yeah, exactly. And, I think you can actually even see the breakdown of the different components if you'd like to see. And, in the fund name, in the bond name itself, you can actually see when it is maturing, as the case might be. Yeah.
Yeah, I see another question. It's very interesting. So they say Stashaway recently cut their cash management returns. Will that happen to Cash Plus in the future? I would say it can go up or down, right? But you're the spokesperson for Syfe. You might want to take this.
Yeah, I mean, we don't really comment on what how other people build and structure their products, but at least when we build ours, we wanted some sort of comfort from our fund managers in terms of what we can deliver, what we can promise. Also, if you think of it, our rates, were somewhere decided at a point where there already have been significant rate cuts, so as to, speak. So I would say, if you put a gun on my head, there is anything is possible, but I would say there's even a possibility the rates might actually go up rather than going down, right? And that is something, which is why when these bonds mature, depending how economies are doing, that is something which we will be able to say. The fact of the matter is that when these things do happen, you will always know we will alert you with sufficient notice in a way that you will know. We aim to at least once a quarter update it, maybe even more if we feel that's the case. And at that point, this is again the advantage of the product, right? If you feel, oh, these guys promised me 1.75, but oh, now they're only giving me 1.7. If you don't like it, frankly, you have the choice just to remove it, right? But obviously, when we had to give numbers, we have ample faith that this will hold at least till the quarter. But as things, mature, we'll probably get along here.
Yeah, and I will jump in because I'm the neutral third party, so I can comment on competitors. But I would also say when I look at, we have to understand that the different cash management products work and are designed differently. So for Stashaway, they're actually invested in 2 out of the 3 that Syfe Cash Plus is in. And so with them cutting the rate, so if you're comparing like why is it different, you have to remember because there's one extra one that Syfe has that others may not have. In this case, I'm really comparing just these 2 that you're asking about. And the third, that one is basically the Lion Global Short Duration Bond Fund, which is not just in Singapore, but also international bonds. So because of that difference in design, that's where you have different rates. And if if one cuts, but remember Syfe still has one more. So unless all 3 get affected, then you have to watch closely as well. Yeah. But yeah, I hope that gives a little more color as to why everyone has different rates and some are cutting whereas some are not.
Yeah, exactly.
Okay, so I think this is funny. Someone's asking, why not give a fixed but lower interest rate for Cash Plus? I personally prefer that you guys don't give a fixed one because then you can go up to higher than it, right? But yeah,
I mean, that's exactly the point, Don. I mean, frankly, I can say 1% and I can be very comfortable, but then I don't want someone to say, hey, these guys are being sketchy and taking this margin out, right? But the reality is that, no one will understand what it takes to actually guarantee that 1%, right? In terms of hedging and so on and so forth, right? So we debated about this and, we thought we'll, give it like a fixed kind of a rate kind of a thing. But in reality, we think, especially again, coming at the perspective that the rates are on the lower side, right? We feel there is more downside than upside even to our customers, right? And we generally build platforms where, we pride ourselves in transparency, right? And I think this builds a setup where we can be very transparent and tell you, by the way, this is what is getting, it's all factual information. You can see how it is, but, if it goes up or down, you have the choice whether this makes sense for you. And at the same time, allow you to do that. I mean, if you start putting fixed rates and fixed durations and so on and so forth, then, we start becoming something that we are fighting, right?
Yeah.
So we are trying to change that perception, right? Because if you give fixed rates, then I will have to put a lockup on you. I will have to, ensure that, you have minimum lockups and so on and so forth. But we don't want that. We want this to be a tool that, you use to optimize your, unutilized cash or, park it temporarily and not really, you know, a fixed return tool where you can get some kind of a fixed return, but, you know, with all the other constraints that fixed deposits come with.
Exactly. And I would also say, like, from a business slash consumer point of view, it makes sense. Because if you see from a business point of view, all businesses should be adding value to consumers by identifying a gap in the market and then filling that gap, right? So what I see is Syfe has basically identified that gap for us. Because it really is, I mean, from a consumer point of view, tell me where else you can get some place where you can park temporarily with fairly decent yield. Even if you look at like 3 months, what are your options for 3 months? Fixed deposit. Well, the last time I checked, that was like 0 point something percent. So it's not very attractive at all. So by them identifying and meeting our needs in this gap, then it's up to us whether we want and we think that this gap is applicable to us, and therefore we want to go for that product and solution.
Right.
If you're someone who prefers a lower rate in exchange for the fixed assurance that it gets, there's plenty of fixed deposits, Singapore saving bonds, and even the short-term endowments that you can look at. And there are some new ones in the market as well. But yeah, and they're also still super popular, right? If we look at some of the ones that give pretty low rates at 1 point something or 2 point something, but yeah, they get snapped up so fast. You can see there's still demand for it in the market because you have people on different appetites for risk, different people who want different view on their money. So yeah, that's exactly, I actually like it that you guys don't give a fixed one. If you had to lock up my money in return for something lower.
Yeah, right. Yeah, exactly. I mean, lockup is, again, like two parts. One is obviously psychologically, you can take the money out whenever you want. And I think the second part, of course, it comes from the fact that, you know, if there is a reverse trajectory or anything, you know, you don't want to get missed out and locked up in the hole. And that's exactly the premise when we were building it out also.
Yeah, exactly. All right, so I think we've covered most of the Cash Plus questions. Great questions, guys. Keep them coming. We can always come back to them later. But now we're gonna move on to the second segment because, like, you know, how I see this is that Cash Plus is great because it's something that you can park in temporarily. But we all want to see you guys move beyond just 1.75%. And if you guys look at what exactly is Syfe, remember they're a robo-advisor. They're not here to help you save and just, like, you know, just save money and beat inflation. That's not the point, right? They were designed to help us, not just save money and risk letting inflation erode that, but they were built and designed, if you look at the founding message and their objective, it was always to help us invest better. So this Cash Plus, actually, I would highly recommend it. For those of you who want to use it as a standalone, it's a great place to park your emergency funds or your temporary cash. But for investors, we're always looking out for war chests, right? And once upon a time, like, Singapore saving bonds and the high yield interest savings accounts were great places for people like me to park my investment war cash while waiting for a crash like the March one that we saw. But today, it's not so attractive anymore because everything is, the rates are all going down, and you know, the SSB doesn't give as much liquidity. So I started looking out for more different options, and that's where Cash Plus is really attractive. So if you're also using it for emergency, for your war chest while waiting for market opportunities, now we're going to cover about the second part. So how do you then invest that? And what will it take if your cash is actually inside Cash Plus? How will it take to rotate and transfer that money into the investment portfolios compared to the old times where we would have it in our bank or in a bond, and then we have to go and liquidate that, take that out, and then put it into the brokerage and invest? So we're going to talk about that. But first, let's talk about the strategy. So some of you might be a bit new, so we're going to introduce a concept that's pretty commonly executed around the world, and it's actually a very good stable concept to approach your portfolio. That's called the core satellite investing, and Syfe also applies this in their solutions and their product. So what exactly is this method about? Now I'll use this example to illustrate in the next image, whereby, you know, using myself as an example, that they're a young 30 something year old person, all right, and you're basically looking to have exposure to stocks, global stocks. You also want some exposure to bonds for a lower risk, and also maybe to hedge it with non-cash assets like gold, maybe. And then at the same time, maybe you really like the REIT space, because let's admit it, in Singapore, REITs are still great investments because we have we don't get taxed on those returns. They get dividends, so they're super popular because that's passive money every quarter or every half yearly or yearly. And at the same time, property in Singapore is a pretty good space to be in. And of course, then you might want to also allocate some to growth-focused companies that are going to grow to become the next Facebook or Shopify of the next 10, 20, 30 years. So in this case, one good way you can allocate your portfolio could be, for example, if you're a medium risk investor, you could put 50% in your what we would call the core. So this is where you have the exposure across your stocks, your bonds, and your gold. But if you feel that it's a bit too much of a hassle to be doing it individually, like instead of buying individual bonds, individual stocks or ETFs, and even gold or gold mining companies or gold ETFs or whatever your flavor is, even physical gold is up to you. Okay, it might be a bit of hassle to manage all of that. So one easy solution that I really like is that Syfe has bundled that together into the global ARI portfolio, and Drew will talk a little bit more about how that works later on. That could be a all-in-one approach to basically cover this core section all at once. Then on the other hand, what we have is satellites. So like, satellites rotating around a planet. So this is where you have your thematic satellite investment teams. So in this case, you could have, for example, exposure to real estate space through the Syfe REIT Plus, and the selection of REITs in there is also pretty solid. At the other time, you can also have one in hyper growth focused company. So if you're a huge fan of Tesla and stuff like that, well, you can actually get into Equity 100 where these growth focused companies are in there. I can't remember. I think Tesla's inside, right? The last time I checked.
Yeah, it is one of the biggest components. Yeah, so
not surprising.
Well, I mean, it was not, but now it has become. Let's put it that way, right? So
yeah, exactly. Yeah, so you can also do that instead of like buying individual Tesla stocks or Amazon stocks or the individual growth companies. You can also do it as a bundled one. So in this case, you can easily have your portfolio covered with just 3 solutions. And I might add, right, just a few years ago, this was not even possible. Because we were all like, if you guys have been investing for as long as I have, and I'm not even at the stage of those who are in their 40s and 50s yet, because they have way longer experience than me. Well, in those older days, you didn't have something like this that made it as convenient or as easy. There literally was a lot of Google forms or Excel sheets to manage all your different investments everywhere around the space. So yeah, this is a really nice approach, but I don't want to be too biased in this sense because I'm only using the example of someone who's medium risk, maybe 20, 30-year-old, and is willing to have that exposure at 50%. So maybe do you all want to talk about one who might be a bit older, let's say in their 40s? How would you allocate it for them using the same approach?
Yeah, the way how we think of it is always right. I think, and this is somewhere where it's important to know exactly what is the complete financial situation of the individual, right? Because as I always say, traditionally, many of us actually have a safe pile of assets, which is either kept by excessive cash in the bank, right? I think that we've been speaking about a lot, but also, such as, CPF deposits or, let's say like a house and so on and so forth, right? So you have all those things which are, how do I say, relatively lowish kind of a risk, but kind of your safe haven component, right? I think what we've seen is that a lot of people, this ends up becoming 100% of their pie. And I think that is when it becomes a little bit risky. So our view typically should be that a part of this should start getting allocated towards, a higher risk asset, right? Such as, let's say, an Equity 100, where essentially, you're getting that kind of growth opportunity, so on and so forth. Now, I know in the last 1 year, people might not think of it this way, but always remember, right? I mean, for us, our homes are in, Singapore, we have a house here, we have a job here, we have CPF here. So everything considered, right? If you already have a massive bias towards, and this is this is not just a Singapore, this is no matter in which economy you're in, you obviously have a bias towards your economy in general, right? But I think a good way to generally build a portfolio, which wasn't possible, but it's possible now, is to maybe globally diversify it. So I would say that depending on the individual, something like an Equity 100 option might be a great option for them to add on to their thing, right? To their portfolio. Now, let's say they have cash, but they don't want that currency risk. I think that's where something like, REIT or REIT with risk management becomes a great tool, because, you're getting your appreciation plus, you're getting your dividends, as the case might be. And then again, if you want to build a holistic portfolio, that is where, RE comes in, where we basically just manage the risk of your portfolio. And, you can go through this analyzer on the website and you can, see what kind of risk level is recommended. But based on your risk level, you can actually see what the allocations will be, even before you move across even $1, right? So you'll get a gauge of what exactly you're getting in before you get in. And I think that is what I would suggest to users to do.
Exactly. Drew, I think we have a really good one on the next slide. I think that wasn't showing up. Do you want to go through that case study?
Yeah, I will. Just please, over to you.
Me? No, you guys should do it because this was based on your advice. So I did the
Yeah, I'll do it.
2001.
By the way, I have the answer to the question that someone had asked about cash plus return, right? So we launched this on Jan 7. So it's been about, I would say, a month and a few days. And in fact, that return has been 0.34% for that duration. So actually, if I analyze it, the rate is coming close to 3.9%, right? But again, I will caveat this that, we know bonds mature, some mature early, some mature fast. So our estimate right now is that currently the projected yield is coming close to probably about 1.8%. So it's higher than the 1.75 as I had mentioned earlier. But if you came in a month ago, then you would have got 0.3, 0.4%, and you can see this already on the platform, right? But we are not cheeky enough to call it a 4% return product yet because we understand how this works. So, but we might basically, if this retains for the next few weeks, we will up our forecast and we will let customers know about the same.
Yeah, if you went ahead to use 4%, I'll be like, are you sure?
No, we don't. We are very, in fact, I would say we are over realistic sometimes, right? So we're still saying 1.8, though we think we might get 2 or something, right? Anyways, but yeah, back to your, analysis, right? So, I mean, essentially, this is a typical example of someone, who might have, $100,000 at the age of 40, is what they can invest at this stage, or at least wants to invest with Syfe, with the goal that, this is an investment which they make for 20 years. So what we really think is that somewhere essentially a blend of the high growth as well as the REIT kind of offering, which is basically income plus growth or income plus saving, depending which kind of model you choose. That somewhere ends up becoming close to maybe half of your portfolio, right? Because you've taken that global exposure with equity 100, but you have a bit of the I guess the REIT exposure and the Singapore dollar kind of dividend play which comes out here, right? The core offering actually can be more focused on what kind of goal you're trying to achieve. Now, if it's a retirement thing, and again, as I said, go through the risk profiler, see what is the right level for you. A 21% downside risk might be right for your retirement. For some people, this number is higher or this number is lower. And then, of course, for something which is a certain expense and something you probably don't want to have too much volatility in, saving something for children's education, right, can be something which is the 15% DR, right, which essentially is more of our so-called medium risk offering per se. Now, again, this is just a sample allocation of how people can think of their portfolios. You don't need to have all 5 of them. You can have 2 of them. You can have 3 of them. Speaking to our wealth experts, which is something that we'll touch on later, can really help you understand our products better so that you can make a more concerted choice as to how you should split your funds. The reality is you can always move funds from one to the other, in and out, as much as you like, whenever you like. Of course, we normally don't advocate that behavior because, as people, end up doing too much, tinkering with their portfolio, it's proven. I mean, I've been trading for the last almost a decade and a half now. And I know that, sometimes that so-called passive approach is the best approach in terms of, staying invested and staying focused on what is your real goal from this investment, right? Rather than, just reacting on market news or GameStops and the likes, which happens so often these days.
Yeah, and I think also like I think what we need to learn from these 2 examples, one from me, one from Drew, is that you guys can see portfolio allocation will differ depending on how much capital you have, what is your target retirement age, your risk appetite, and also your preferences.
Yeah.
So that doesn't mean that just because someone who is 40 years old with 100,000 and aims to retire in 20 years must definitely stick to this allocation. When you speak to the Syfe team, they may recommend you something different once you actually share your goals and objectives with them. Similarly, although it is generally quite true that the younger generations, those in their 20s and 30s, tend to take a little bit more risk. That's why you see actually a majority of the GameStop people were all like in the young ones, right? And the older ones you saw in the media were basically because their kids or the young folks who tend to get in, so they went in. But by themselves, they generally don't really operate in that space because of the high risk, high return kind of mentality. So in this case also, we can't definitely rule out that all people in their 20s or 30s are definitely going to want to stick with a 50% call. You can actually tweak it to your advantage. So if you have a trusted advisor, you can speak with them. If you don't, you can also speak with the team at Syfe to try and understand what works better for you. And remember, at the end of the day, portfolio allocation is very much personal. That's why it's called personal finance, right? So yeah, I hope these two examples give you guys a good understanding of how portfolio allocations work. And what I really like is just look at how little tools there are to achieve this whole thing. Super easy.
Yeah. Great. Great. So I see a bunch of questions, but I feel, if once we get through this, we probably should be able to answer. So how do you really start, right, with this thing? So essentially, it's very simple, right? I mean, just either get on the app or, get on the website. You hit the get started button, and as soon as you fill in a few questions, you can actually see a portfolio recommendation. Or if you know what you want, let's say you want cash plus or you want REIT, you can actually choose the product first, and thereafter finish the kind of questionnaire, right? Thereafter is a very interesting and something that people really like to see is a forecasting tool, where we actually tell you what is a likely scenario, what's a good case scenario, and what's a bad case scenario. This will also tell you what this money actually means for you, when you actually look at your future, and what can this really mean, 10 years down the line when your daughter is going to school, or 30 years down the line when you're retiring, etc., as the case might be. And thereafter, there's an app, which by the way is going through a massive upgrade, which you should be able to see over the next few days. I think we're going to start rolling it out very, very soon, which to actually easily monitor the app, to easily monitor your portfolios, and even then a summary of portfolios as the case might be. So what does this cost, right? Now, Syfe Cash Plus, which is one of the premise of this thing, is actually a zero management fee option. As I mentioned, even if you have other portfolios, there is no fees deducted. You get everything as it is, right? Whereas the investment portfolios such as Global RE, Equity 100, or the REIT Plus, we have, 4 main tiers, the blue, black, gold, and platinum. The blue tier is essentially for any amount which is under $20,000. Now, this is interesting. When I say under $20,000, this is the sum of all your portfolios, all your investment portfolios, hence excluding cash plus. So if you have, 5,000 in, REIT, and then, 10,000 in RE and 10,000 in Equity 100, this combined becomes 25,000, and hence actually you're not in blue, you're actually in black tier, right? So we look at your overall assets under management in the investment portfolios, as you can see on the left of the screen. If that overall sum, is over $20,000, the fee reduces to 50 basis points. If it is actually over $100,000, and that fee reduces to 40 basis points, right? The advantage of black and gold is that you actually also get access to wealth experts. In fact, in gold, you get a dedicated wealth expert. If you're a platinum customer who's planning to invest more than $500,000 in our investment portfolios, do get in touch with us. We have some offerings, which might be bespoke and might be very worthwhile for you to actually explore. As I again mentioned, that cash plus is not included, in your overall AUM tiering, but also it's not charged any fees, and that's the reason of that. Yeah.
Yeah, and I just want to add a little something on this slide. So guys, if you're familiar with roughly how the investing scene, especially in Singapore, work, or even globally, right? It's not easy to get access to someone who will advise you and actually come up with something a little bit more customized to your personal circumstances. So usually these are the private bankers, and we all know how much it costs to get access to private banking services, right? But in this case, I think what I really like and I think is unique about Syfe is that even if you're really skeptical and you just want to be maybe I'll try it out for a while first and then I'll decide whether I want to put in more money, play safe, well, that's fine. But even if, let's say, your amount in the beginning is, let's say, $100, I mean, you shouldn't be, because it's going to be quite hard to allocate just 100. But let's say if you're starting with just 100 or even 1,000, you can actually get access to their wealth experts in the first month and just have that quick conversation a little bit more about what you hope to achieve, and they can point you in the right direction. And then as you go along the way, you not only benefit from lower fees, okay, which by the way, even if you put in a very minimum sum, right, at the blue tier, you realize that the fees is still really, really low. We all have this investment golden rule that we always try to preach, whereby keep your fees below 1%, because anything above 1% in the long run is going to eat up. If I remember correctly, I wrote an article about this. I think 1/3 of your wealth in I don't know how many years. Yeah. So more than 1% is usually a no-no for most people. And in this case, you already get less than 1% even without having to commit to a minimum sum. And then as you upgrade, you get more comfortable with their offerings and you upgrade that. You can actually see the fees go down. Plus, you can also then continue to consult their wealth experts if you held back on certain information. You know, like some of us were very wary. We're super skeptical and do it a bit too much. And then like we don't want to give out everything because we're worried that people are going to use that to sell us more stuff. If you fall in the category, that's fine. But then as you go on to the next few categories, you can also still then start to open up and you'll see that they really try to customize things for you, right? So I think it's a really good way of how they've tiered this. So if you're a super beginner, okay, this is a really good way to get started. Even if you're an experienced investor, I still like it because it's convenient. Like trying to manage everything on other stuff is difficult. And if you want, like, imagine trying to manage for multiple people other than yourself. It's going to be a headache. So in this case, it can actually be quite useful and straightforward because you can use Syfe and just monitor through one or two tools. Super simple. So yeah, I really like how they design it and you should definitely check it out.
Perfect. Awesome. Thank you so much, Don. Yeah, and I think Don mentioned it. You can speak to one of our wealth experts. I see Melvin's actually with us on this call. You can book it easily. The first session is complimentary, no matter which tier you are in. They are extremely busy these days, so please bear with us. And plus it's CNY that we might take a week or more to get you a slot. But in the meanwhile, if you have questions, you can even send them to support at Syfe or call us on our number, which is also on the website, to guide you through any questions that you might have.
Yeah. Okay, we're gonna take some questions now at the same time. Should we take questions now? Yeah, we should, right?
Yeah, a bunch of questions. Let's go. Yeah, so.
Okay, we're just gonna keep these slides here so you guys can also sign up for the next upcoming webinars. But okay, we have a question from Manwai on the ARI. I think this is a really interesting one. Juve, you want to explain a little bit more about how the ARI works?
Yeah. Sure. We actually have a dedicated, seminar which actually gets into a deep dive into our investment strategy. I would strongly recommend that one is normally done by myself and Richard, who heads our, portfolio construction and risk management unit. But essentially, the concept of RE or ARI is basically automated risk managed investing. So I think the premise of this is that we've been in markets for long enough to know that returns can't be guaranteed, but risk can be managed, right? And what we're really trying to do out here is manage the risk of your portfolio. So keeping that in mind, what we do is that after we assess, based on the questions you filled and, the kind of risk appetite you have, we actually try to quantify and give you a risk number. Now, this number, let's say, is 15%, right? So our view is that, you say you can't lose more than 15%. Now, and without getting too technical, there is a concept called efficient frontier in finance, which normally suggests that for a particular level of risk, if you're on the efficient frontier, that is the one that has the highest, ability to generate returns, right? Or the highest so-called Sharpe ratio, so as to speak. So what we do is that we, based on your risk, we actually automate and we build a portfolio on that risk level. And then we constantly monitor this portfolio. So if we feel that the risk of the portfolio is going up or down, we will actually rebalance it. We will buy and sell as the case might be to bring it back within your desired level. Now, the advantage of this portfolio, or I think the thing that some people love this portfolio for, is its focus is a lot on risk management, right? So if you are a bit of a risk averse individual who is a bit concerned about, I guess, losing your wealth or, market correction, so on and so forth, you might find something like this very worthwhile, right? And I'll give you a very good example how it really worked, for the REITs trade last year in a moment. But at the same time, if you are someone who is here for the long run, who can take those short-term, movements, where markets can go up and down, and you don't really, you can survive it. Then essentially, maybe, you probably your aspect of managing risk might be slightly lesser important to you. So it's a very individual to individual perspective. But to give you an example of last year, we have the REIT offering with and without risk management, right? Now, last year, actually, since we launched REIT 100, the portfolio actually generated close to 16%, right? Because we launched it in April, right? But if I look at the whole year, like, we were not live on January 1st, 2020. But if I look at the whole year, the REIT 100 performance actually was flat. But if I look at the performance of REIT with the risk management was actually 5.5%, right? Plus. So essentially, depending on, where your risk appetite is, one or the other of this option might be more suitable for you. But in premise, if you want somebody to manage the risk of your portfolio, whether it's a global portfolio across equities, bonds, and gold, or whether it is, your REIT portfolio, where we basically will either, if the markets are too risky, we will sell REITs and buy government bonds, or if the markets are, much calmer, we'll sell the government bonds and, buy the REITs. Then the REIT with risk management might be a better option for you.
Yeah, just note that if you're going for the risk management approach with ARI, then there will be certain actions taken to protect that risk downside when the markets go down. But that also means that your upside is then capped, not really capped, that's not a good word. Your upside is also affected because of that risk part. So I think there are some misunderstanding in the past where people don't really understand why the ARI one doesn't do as well as the without the ARI one when the market starts trending up, but it's really because of how it's designed. So back to objectives. But at the end of the day, these are just tools. So you need to know, are you willing, if you're not willing to lose money at all and you're like going to be not able to sleep at night, then the ARI one might be slightly better for you. But then you have to remember also what you're trading off in return. I personally prefer the one without the ARI, but then again, you shouldn't follow me because I'm a little bit more of a risk taker, given that I have a longer time frame, right? You might see also some asking. I think Melvin already answered this. Melvin, you are super fast. I was looking at this question on that someone had on the REIT portfolio. And just asking like how historically has that return like. So I just wanted to share with that attendee that the REIT Plus portfolio, when I studied previously, it actually replicates the performance of the IHS REIT index. So if you don't really know what that is, it's basically the ones with 20 quality REITs, or even more like 19 quality REITs right now. At the point where I reviewed it, it's about 700 properties in Singapore, might be a little bit more right now. And they basically consist of big names or blue chip names in the REIT space like Ascenders, Mapletree, CapitaLand, Capital, and the returns really would be tracking these. So like for example, 2020 was fantastic for Capital DC REIT. So that probably helped to boost it. But at the same time, I think like the commercial and mall side was affected by the recession and pandemic and lockdown. So I don't know where it was in the end, but you can actually look at the performance on the SGX side as well if you want to look at it historically. There's also some really good questions, but I think again Melvin has already answered that. Is that some were asking about foreigners versus Singapore. What's the difference between investing in Syfe? I'm also curious because I've never considered from the foreigner perspective. You?
No, there's absolutely no difference. The same, rules apply, right? I think if you're a foreigner, sometimes you might just need more documents because of the MAS guidelines. But reality is that if you're a foreigner based in Singapore and let's say you leave Singapore, as long as you update us, you can actually keep your account even outside Singapore. So we do have customers who are non-residents of Singapore and residing outside Singapore. So it's exactly the same. There is absolutely, no difference. We are a very democratic organization that way. So we have same terms for all. Yeah. So.
Yeah, so I think it's just different documents needed. Melvin has done a good job of listing the type of documents in the answers. So if you guys are on Zoom, you can take a look. Some are asking also okay, so I think these questions actually really interesting. Someone's asking for REIT Plus with risk management. If they put in $1,000 and I did the transactions, allocated it accordingly, over time, would this allocation change even when I don't top up new funds given changes in market performance?
Yeah, it will. I mean, there'll be two factors that will decide, if the composition changing. I think the first would be just the mark-to-market moves, right? Like, let's say if one REIT like doubles in value, like we will not really sell it off, just because it's double. It will still become a bigger part of the of the REIT portfolio. Now, I think as Don mentioned, we've actually built this portfolio in very close collaboration with SGX, and they run this, the iEdge S320 index. They constantly monitor, which are the best REITs, and they remove the not well-performing REITs, and they keep on adding they have a very great team out there. So as they update their index, right, we will also update, your, I guess, REIT component for your portfolio for you, right? And that is why even if it's the same $1,000, it is actually constantly managed by us, right? And that's the reason also why we charge fees. So you are obviously at all points in time, doing the latest or keeping the latest, and which is, sometimes people don't understand the value of this, but this thing is almost impossible to do, humanly, unless you dedicate a lot of time and also a lot of money. $1,000, if you're going to rebalance a REIT portfolio, you probably have to spend $500 in just brokerage fees, right? And the minimums that the different brokers charge. But here, in fact, you all you pay is, your 50 basis points, right? Or 100 basis, sorry, 65 basis points, as a Syfe fees might be.
Mm. And there's a follow-up question. So someone's asking, so let's say given the REIT Plus portfolio with management, right, the risk management RE, when would they be rebalanced such that more of the bonds are actually sold off, but not the REITs?
Yeah, so when more of the bonds are sold off and for REITs, so great question, right? So how the risk management works in a setup is that essentially when markets are like volatile, it is obviously a bit skewed towards bonds, right? The good thing though is that there's a lower cap of 50% on the REITs itself, right? We don't go below 50% because it's a REIT portfolio, it's not a bond portfolio, right? But what happens is as markets get calmer and calmer, there will be an increased allocation to REITs and a decreased allocation to bonds, right? So if I look at 2019, there were phases where it was about 60% to almost up to 80% out into REITs. Obviously, when the markets turned volatile and the risk actually increased, obviously the risk is kind of still considered on the higher side. I know the markets are rallying, but it's still a very volatile environment. Currently, the lower cap is still maintained, and it's been maintained for the last almost, I would say, 6-7 months now, right, running. But the reality is, everything considered, the risk management portfolio still performed better as compared to, a pure REIT portfolio, right? Last year, right? Of course, there are years which, REIT will perform better. And hence we say, it comes down to, your choice and your preference, Mai. And that is something, that you should look out for.
Yeah, so an easy way to think about it is in volatile times, so safer instruments or perceived to be safer, like bonds, would come in more heavily, and in calmer times, then it will be the opposite. So
exactly.
Yeah. Another question. So I remember I looked at it before, but I can't remember. How often is rebalancing done? Is it quarterly or is it half yearly?
Yeah, so it depends on the different portfolios, right? So for the risk managed options, because we monitor risk on a daily basis, it will be done whenever there is a need, right? There could be phases where, this rebalance happens twice in a month, and there could be phases where it doesn't happen for 2 years, right? For our equity 100 portfolio, the rebalancing actually happens, twice a year in April and in October. And that is something which we do as and when that happens.
Yeah. Okay, and this is interesting. I'm guessing this is going to be more for the equity 100 and your REIT Plus, but they're asking, do they get dividends? I know for REIT Plus, it gets reinvested automatically. Is there an option? I can't remember. Is there an option to do so?
No, so all dividends by design get reinvested. You get 100% of dividends as and when they get paid out. For our black and above customers, they can additionally choose to withdraw these dividends on a quarterly basis in their bank account. So it's more like an auto withdraw function, but in reality, you can also withdraw it yourself if you really want to. But the financial gains or the financial dividends are same and uniform across all customers.
I would encourage you guys to reinvest your dividends.
Yeah, I mean, I was running those numbers, right? If you reinvest your dividends, and again, one of the great advantage of working with platforms like us versus a DIY is that if you reinvest your dividends, on average, you will get a 50 basis points higher return. Or the last 10 years, we've ran these numbers, right? Which pretty much basically pays for your fees, right? So if you need the money, definitely take it out, right? But the reality is dividends are such a small part of your portfolio. You generally probably don't need that money. And I would still strongly recommend reinvesting, right?
Yeah. Plus, if you were to try and reinvest on your own through other methods, there's all that costs to think about. But
it's incredible, yeah. Yeah.
Yeah. Okay, I see someone's asking about Cash Plus. So who actually owns the bonds or portfolio? I'm guessing the Lion Global portfolio is their custodian bank.
Yeah, the custody bank is HSBC. So all the assets are actually safeguarded and kept with the custodian, which is HSBC in the case, right? I think the question is like, how safe it is. As you know, right, given the fact that we are CMS licensed by MAS, there are obviously very stringent controls both internally and externally in the setup. So even, in fact, I would extend this outside Cash Plus. Even for our global, securities, they are custodized with Citi. Our Singapore-based securities are custodized, with HSBC, as well as the Cash Plus securities. So essentially, there's a proper mechanism in place to keep customer assets very different from our assets. I mean, our own operating assets are actually kept in a completely different bank, which is not even the trust bank, DBS, etc., which we use for customer assets to come in. So I mean, the assets are extremely safe. And obviously strictly adhere to all MAS guidelines at all times, right? And that is, of course, as a regulated entity, that is something which you really have to do. And we have our in-house compliance, external compliance, audited by Big Four. So a lot of those bells and whistles are already in place because of regulations, as the case might be.
Yeah, I like that a lot of people are asking all these nitty-gritty questions. So I hope you guys are a little bit more assured now that you understand how exactly it works. Because yes, it's a legitimate concern to worry that if the business closed down or if the folks run away, then what's going to happen to your money, right? But there are all these measures in place also because people like businesses know that this is what we're worried about. So they have to put in several measures and layers to make sure that our money is protected versus the business own operating expenses and everything else. So yeah, I see this really interesting question. Someone's asking, has there been any studies done on the correlation of the level of customers' interactions with your apps, like how often they view it versus their portfolio performance? And the follow-up question is, do you recommend Syfe investors to regularly check their app? Wait, I'm gonna attempt this first because, like, guys, I want to say something. I saw during the crash last year, a lot of people panicking and posting screenshots of their robo-advisors, not just Syfe, across different platforms. And they were putting on Facebook and Instagram. And, in February, March, April, they were like putting in and freaking out. And then they were asking, like, should they withdraw? And I was just like, And then after that, when the market started turning up, I again saw people going in and they were posting like on a some daily, some weekly basis and talking about how, I made a few dollars here and there. Guys, I don't really recommend checking your apps so often because I mean, the whole point of it is you want to go for something that's managed a little bit more so you can focus on something else in your life, like, spend time with family, grow and build your career, study to self-improve yourself or pick up a new skill. And if you're going to be checking and micromanaging it, then I think you're kind of not giving the tool the credit that it was designed for to really take all of that effort and headache off on our hands. But yeah, I mean, that's just me. Drew, what would you say to investors?
Like 100% agree, right? Like I mean, I myself don't log on to the Syfe app, and I mean, I've got big investments with them, right? Because see, at the end of the day, you have to ask yourself, is this an investing platform or is it a trading platform for you? So I know we all most people, they like a little bit of, I guess, punt or trade and so on and so forth. And if you're already doing something of that sort, I think it's good for fun. And if you want to do it on the side, do it. But most people are not qualified or, sophisticated enough. And a lot of people have burnt their money, as you know, real investors in GameStop and so on and so forth, right? There are a lot of blogs which are doing the rounds and, people in Singapore coming out and saying, how I burnt through my savings, in Seoul GameStop debacle. So we always say that it's an investing platform. And as an investing platform, frankly, I think if you check in maybe like, I don't know, once a month or, once, every few weeks, I think it's still okay. But if you're going to be looking on a daily basis, it's human tendency to act, right? And a tendency to act can be to either withdraw, change portfolio, increase, decrease risk level. Generally, if you are aligned to these things, and if something fundamentally has not changed in your life, if there's fundamentally hasn't changed, or there is a fundamental concern, let's say there's a war or something drastic is happening, I generally think you don't need to, look at these things, right? You look at it when you need to. You look at it, you've look at it once. Sometimes I'll tell you, like, I sometimes log on once in like 3-4 months, and I'm sometimes, oh wow, this is a cool new feature we've got, and I feel really happy about it, right? So I would say that don't, yeah. I mean, unless you need to, don't. I mean, don't. It's not like going through Instagram and going through photos, because this is money involved, and we had some numbers, and I'm trying to remember what the exact numbers were, but we actually saw that the people who had not acted in March had ended up getting close to, I would say, they actually basically end up getting about 8 or 10% higher than those who acted, because many of them, they just stayed out for too long and they still think they can time the market and re-enter the market, so on and so forth. It's easier said than done, right? I mean, what is the right time? You can put a gun on my head and I don't know if right now is the right time, right? So I would say that, do it when you need to, but it can't be one of those things where you're getting bored, so I'm going to press a few buttons around here and there. So let's put it that way. And you get your monthly statement, right? So once a month you'll get an email which can even tell you what it is. But of course, if there's a life-changing event, you've got a very strong view about something, or you genuinely need to do something with the portfolios for whatever reason, maybe you have a windfall and you want to increase the risk or level that you've had, or you've had an unforeseen expense and you want to probably decrease the risk level. All that is completely fine, but don't tinker with it daily. It probably is going to do more harm than good.
Yeah, exactly. I think it's interesting that you say people who check their app a lot more during the crisis versus those who didn't actually acted and then got lesser returns. I think it's just human nature, because if you see things going down, you're gonna panic, or you're asking your friend, what should I do? And if your friends are not savvy enough, they might be telling you, better cut loss. And then that's like, okay, but then when will you ever get back in? Right? And there's also the anchoring thing to think about, because like when you see it low and then you're like, and it goes up, sometimes it's also hard to get back in, because you're like, no, but I was at that point 2 weeks ago.
And then there's never a good price, right? I mean, and then there's no end to this thing, right? So again, I mean, I would say if you have a small percentage of your net wealth which you want to trade with, do it. That's fine. Watch it every day, watch it every hour if you must. But this is still more of an investing platform, and this is towards long-term wealth accumulation, right? That's how we think of it.
Correct. So remember, guys, it's designed to be more passive. So if you want more active work, then you might want to look into other places and whether it really can help you achieve your goals. But I think the appeal of this is really the convenience, the passiveness, and the low fees in exchange for not having to do all of that work and just monitoring it in I would say every month is the max, if not like every 3 to 4 months on a quarterly basis is good. Anything more than that, you're likely going to be acting, because we're all just humans. I think another really good question, and I actually applaud this. So someone's asking, do you recommend DCA for REITs and equity 100 portfolios, or lump sum figure would be better? And for those of you who might not be familiar with DCA, it refers to dollar cost averaging, whereby you put in a set amount of money every month, for example, $100 every month, so on and so forth. I'll do a quick one, and I do very love to hear your take. But personally, for me, I think whether it's DCA or lump sum, right, really depends on you. Because yes, there have been lots of studies out there that show that maybe sometimes lump sum investing is actually better. But no, wait, actually a lot of those studies were on more of active stock investing, whereby you get fees each time you transact. Not really the case for Syfe, whereby it's the overall management fee, so slightly different. But generally, like, you really need to be looking at yourself. I mean, if you lack the discipline, I think it's easy to set up DCA, right? And it keeps you invested all the time. But if you're someone who like only looks at your finances like every few months, or you're maybe a commission-based role, whereby you can go several months with very bad cash flow while waiting for your commission to come in, and then like after that, like 3 months later, boom, everything is in and you have a huge amount of money in your account. So then maybe for those kind of cases, lump sum could work. So it's really up to you. I think there's no right or wrong between both. But Drew, what's your take? What do you personally do?
I mean, I personally lump sum, and I'll tell you why also my rationale is, right? See, the thing is that I agree to that one point though. See, at the end of the day, if you have the resources, then I would lump sum, right? Because in my view, I don't believe in timing the market. I believe the time you have in the market. And in fact, we probably had this somewhere, but there was this significant research which was basically done over a very long period of time, and which said that in 74% of circumstances, if just investing in SPY, lump sum over a 2-year period, like let's say in 24 months, do you put at the beginning or do you put like equal in 24 months? 74% of the time, as in 3 out of 4 times, lump sum actually outperformed, DCA, right? Because you just...
Inclusive of cost though.
Sorry?
But then inclusive of transaction cost though.
Oh, that's the beauty of Syfe, right? There is no transaction cost for you, right? And again, this is related to Syfe, right? Because if you have to take the cost, 100% agreed. But then even lump sum is then even better, right? In that view, because lump sum would be a lower kind of, cost. But again, with Syfe, there's no difference in these two, right? So essentially what happens is it has performed better. And essentially the view has always been that, that if you have the time, you should use it to your advantage and on your side. Now, in reality, we're also conscious that some people might not be able to lump sum. If you are typically a salaried employee, and if you have something which is more on the lines of you're getting only some money to deploy every month, then by all means DCA and tools like I guess like Syfe are great for help you to do that. But if you have the optionality, I would strongly recommend lump sum, because I feel that it gives you longer time. But again, then you have to close your eyes. And if you're going to put a lump sum and then look at it every day, right, then you're running a bit of a risk, right? Because then you start timing the market, and that's where things get a little bit loose. Yeah.
Yeah, and I would say, like, if you're doing lump sum, remember to do it, because it's so easy for people to say, oh yeah, I do lump sum, and then like completely forget when the time comes. And then end up like maybe if you might completely not even be invested, which is worse, because you want to be invested in the market versus staying out. So yeah, depending on your preference, we have talked about both DCA. A lot of times when people kind of prefer lump sum over DCA, and in a lot of those studies, you have to remember it's because it was in an era where cost was literally per transaction. But with Syfe, that doesn't apply. So you can't just use an old study and assume it's going to be exactly the same, because some of the factors are different. So that's why, like, look at your own personal like style and what works for you best. If you're someone who's a bit scared, you don't really know how to do it, and you're just getting started, or you want to build in that discipline, I would recommend many investors, many beginners to go for DCA.
Yeah. Exactly. I mean, you said, I by the way, I agree. I mean, I've seen your data, but I think comfort trumps data always, right? So it's there. Someone's asking, how is the fee calculated? It's very simple. It's just calculated of the assets under management. So if you have $1,000 this month, it will be only computed on $1,000. Then you DC and make it 2,000. The next month, next month will be 2,000, because it's computed on a daily basis. We look at your daily, NAV, and we basically calculate fees on that. So it's very, very transparent. You can see detailed breakdown and workings on our website. But essentially, think of it: you pay fee every day for only what is invested at an annualized rate of, let's say 0.4%, depending on the tier you are in Syfe.
Yeah. I think the rates are super low, so it's fine.
We've gone through a lot of questions. I feel a little bit, my throat's feeling a little parched right now.
But I think it's okay that we've finished answering all of those questions. And guys, we had really good questions tonight. Thank you everyone for sending in your questions. I hope you guys found this webinar useful. I think we're just gonna end off with a promo. For those of you who stayed right to the end, there's a promo that Drew is gonna bring up on.
I'm just gonna get on, and we just got somebody screaming with a massive wait. All right, anonymous attendee, we will wait for you, right? So, all right. The elephant in the room. When can we use SRS CPF funds? Trust me, if it was my way, it would be yesterday. But there are some things which we have to work with the regulators and MOM and CPF board, etc. We are in different levels of conversations with them, and we are working with tirelessly to make it happen. But bear with us. The day we can do it, we will actually, we will, trust me, you will know as soon as we know. Let's put it that way. Yeah. So let me get that promo code out. Hang on, there it is.
Yeah. Would definitely love it if you guys manage to get SRS approvals to invest as well. I mean, the product's already good as it is. If we can use our CPF or SRS for it, SRS as a start, that'll be fantastic.
Yeah, no, thank you so much. And I think we do agree, and it's a very, very common request coming from our customers almost every other day. We understand the importance of it. So it's work in progress. Bear with us, and we are taking on it at very, very high priority.
Okay, so promo time.
Yes, so please, I mean, the QR code, please feel to scan. I mean, Cash Plus is anyway free, but you can make your investment portfolios also free for the next 6 months. It's up to the first $30,000. And of course, I think the key TNC is that this has to be invested for at least 3 months, right? Otherwise, it's a little unfair in some ways to us. But otherwise, you can see the terms out there, and give us a go, and we look forward to hopefully seeing you at one of our upcoming webinars, which happen every week with different topics and with different people across the company presenting them. Thank you everyone for joining us today. Dawn, any closing thoughts from you?
No, guys, just to reiterate, the promo is actually not bad, because if you go and calculate it, right, if you do lump sum, that's immediately like $75 of savings, because you're getting 6 months free. So if you're even if you don't have that much money, don't worry, because it's also a good start and the fees are really super competitive. So I highly recommend that you guys go and check out the different tools that Syfe have. We haven't been able to cover in depth into every single type of portfolio and how they work, because today's focus is helping you guys understand Cash Plus. But don't forget, that's just the first step. Remember to take the second step as well, which is to invest. And that's where you can go and check out all the resources they have on their website. I also have reviewed particularly the Equity 100 as well as REIT Plus portfolio in detail on my blog. So if you guys like the way I analyze it, you can also check it out. But yeah, hope that you guys enjoyed tonight, and we'll see you guys again soon. Thanks, Drew.
Thank you so much, Dawn, and wishing everyone a very, very happy CNY. Kong Si Fa Shai, everyone. So, all right. Thank you all. Thank you, Dawn, so much for your time. Really appreciate it. And thank you, Melvin, for answering those questions at a remarkable pace. Yeah.
Thanks, Melvin.
Cheers. All right. Bye. Bye.